Is investing gambling? Or is it boring and predictable, similar to watching paint dry or grass grow as it's often been compared to? Well, given that the stock market seems to continuously be on a roller coaster ride, it's difficult to argue that it isn't gambling. Take a look at this video to find out the similarities, and yes, there are similarities, but more importantly, the differences that mean when you invest, you're not just throwing your money dice and hoping for some big win. Hi there, welcome to my channel. Let's talk money and how to get more of it. Speaking to a number of women as to why they don't invest, one common theme emerged. Many of them see investing as gambling. And when looking at the definition of gambling, you will find the following in any dictionary. It is risking your money in a game of chance to win more money. Looking at that definition, there are distinct similarities with investing. Number one, it is a game of chance. In other words, a chance of making more money. Number two, there is risk involved around your money. But to be honest, there's risk involved around your money no matter what you do. If you put your money under the mattress, it loses value because of inflation. Not to mention the household hazards of potential fire, your pets getting hold of it, or whatever else can happen in the household that could destroy your money. If you put it into the bank, it loses value because of that horrible specter of inflation, as you're unlikely to earn an interest rate higher than inflation. And if the bank goes bankrupt and you're not covered by a compensation scheme, you could lose money. If you put it into the market goes up and down, and if the market goes down, your investment loses value. But remember, it is only a paper loss unless you decide to sell your investment at that point and make it a real loss. However, there's no more certain loss than through gambling. While there may be a few wins along the way to entice you back into the gambling game, the odds are stacked in the favor of the house. And history has shown us when it comes to gambling, in the long term, the house always wins. Now, all of this doesn't give much comfort that investing is not gambling. So let's take a deeper dive into the two. The first theme to explore is that they both seek to minimize risk and maximize return. But it's only investing that has the true tools to do this. The tools available to the gambler include his intuition, emotion, maybe some psychology, and just simply staying out of the gambling game. The tools available to the investor, however, include 1. Diversification, not putting all your eggs into one basket. And the strategy behind diversification is not only about risk mitigation, but it's also about blending a variety of different investments into one portfolio so the investor is able to provide a consistently high return over various economic cycles. Number 2, the ability to create a portfolio from passive investment index trackers. And that simply means investing in an index tracker that just basically copies a specific index. And it's by passive, it means there's no real human intervention in choosing the selection. The selection has to be exactly what's in that index. So in other words, you could invest in a global equity index tracker that's passive, and it simply tracks the largest companies in various geographies. So for example, you would have exposure to Amazon and Apple and Facebook and HSBC and in the UK BT and Barclays and such. And so with a small investment, you can create a well-diversified portfolio by using these passive index tracker funds. Number 3 is knowledge, sticking to the mainstream investments and avoiding those get-rich-quick money-making schemes. If your intuition is telling you that it seems too good to be true, it's likely because it is too good to be true. And lastly, the 4th tool is patience. As I mentioned in the intro, investing is similar to, or has been compared to, watching paint dry or grass grow, and it's like a marathon. So basically, you just require the discipline to consistently invest into the assets and the patience to leave those investments to do what they need to do over time. The second theme is access to information. Companies listed on a regulated stock exchange are subject to very stringent initial and ongoing reporting requirements to help investors have sufficient information to make informed decisions. Gambling, on the other hand, is an opaque game of chance with limited to no information sharing. Theme 3 is that gambling is an all-in. Once you have entered your gambling transaction, you are all in. That is that. There is a binary outcome, and that is that you may win or lose. Simple. Investing is the act of putting your money to work to provide an income and hopefully as well future capital growth. So Warren Buffett, the legendary investor, defines investing as laying your money out now to get more money back in the future. So simply put, investing is the act of putting your money to work in different types of investment options to earn an income and grow your money over time. Investing can provide an ongoing income by way of dividends from shares or interest from your bonds, as well as the capital growth on the money invested. Now, if the market crashes, you have suffered a loss, but it's only a paper loss, as I mentioned earlier, and it will only become a real loss if you crystallize that loss by selling. If you hang in there and wait for the market to recover, it's likely that your investment will recover its value over time. If, on the other hand, the crash is related to the health of one particular company that you're invested in, you don't necessarily have to wait to lose all your money. You can sell out of that asset when you realize that there is something not quite right, unlike gambling where you're stuck into the game. So the outcome of invested capital, it's not binary. And it has been historically evidenced that if you invested in a well-diversified portfolio of mainstream liquid assets, there is a high chance of the portfolio having a positive outcome over the long term. My final theme is the evidence. So investing based on proven mainstream low-cost strategies over the long term will produce outsized returns. And so when looking at the cumulative return on the stock market versus, say, the chance of winning the lottery in the UK, my money is on the surer bet. The cumulative return on the S&P 500 over the last 30 years has been, and just wait for it, 1,000%. That's over 1,000% to be accurate. And that translates to an average annual return of around about 8.5%. And this is over a number of financial crises and a pandemic. So compare this to the potential of winning the UK lottery, which has a 1 in 14 million chance of winning. This is even less than the chance of getting struck by lightning in the UK, which is a 1 in 10 million chance. Now, I prefer the likely option, and so I'm sticking my money in the market. And yes, I do confess, to a small little extent, maybe also playing the lottery. So if you want to get started investing, please grab the Investing 101 workbook below and see what needs to be done. And if you like this video, please let me know by hitting like. If you know any other ladies who want to change their financial story, please share it. And if you found anything useful, please let me know by commenting. For financial education and money talk designed for women, subscribe to my channel and hit the bell to be notified when I post a new video. It's been great speaking to you, and I hope to speak to you again in the future.